Happy Wednesday, everyone. I don't know. Yeah, you hear my definition. There's no such thing as a happy Wednesday. This is actually a pretty good Wednesday. We're getting close to the end of the semester. Everybody's kind of winding down, and momentum seems to be strong. So I've mentioned it many times. This will be the last time I'm going to mention it, but Friday, Excel assignments are due. If you, I've talked to a lot of people, which means you're being proactive on that. So good job, excellent work on that. A lot of people have already submitted. If you've not started yet, today's the day. Start now. At the very, very latest, start tomorrow. I wouldn't recommend it. I'd say start today. Again, it is not a difficult assignment, but it is time consuming. As I heard the quote is, it is a pain to clean the data. It is very much a pain to clean the data from Morningstar. I did want to talk very quickly about that because I did receive some questions. There were some questions about the balances, how they worked out. Generally speaking, you can kind of tell where the sums should come from because there are subsets of anything that's a lower level down. So like total assets, for example, is just going to be the sum of total assets or total current assets and total aren't current assets. And you can check that. Use the detail in the example to kind of show down how far you want to go down. I'd say basically 2 levels is probably sufficient. You don't need to necessarily go down to the 3rd or the 4th level to break down. I think if you start or if you basically move this level and then kind of sum on total current assets. So list out the different current asset categories, list out the total different non-current asset categories, you should be fine. Use your judgment on that. So the only reason I say that is because some of the financial ratios you will want to have more detail than just what current assets are in total. You might want to have detail on different current assets like cash and cash equivalents and inventory and things like that. One thing that did come up, it was a little bit confusing, is that you will notice that these are very large numbers because these are all large companies. And so some of the numbers that we added together did not particularly add well. So you can kind of tell what the number should be. This should be 99, 46, 100, and it does add it together. 100,000. So some of the companies that were really large, they rounded to the nearest million and they got some rounding errors. So they're $1 million or $2 million off. I'm not terribly concerned if that's just a small amount off, which I say a small amount. I'd love to have $1 million, but relative to the company size, if we're talking about $1 million off for a multi-billion-dollar company, or even a multi-billion-dollar company, that's not a big deal. You can basically impound that number into some other area, and you can leave a footnote saying the rounding error just kind of left it a bit off. It's not a big deal. It does not need to be perfect. We're not doing my father's checkbook, so it doesn't need to be reconciled to the penny. Basically speaking, you want to have a good placement and what's a reasonable representation of what the financial position of the company is at a point in time. Keep in mind that you will have to compute the formula. So anything that's a function of another number, you do need to include as a formula. So total assets right here should not be listed as a static input because total assets is a sum of all the assets that are in the organization's balance sheet. So you do have to do those calculations. And it's not particularly difficult to do. It is, again, like I said, time consuming. And this is just pretty much what you learn in your financial accounting class, how to put that together. I have already cautioned my GTRA Matt, who's responsible for the feedback on this, and said that he may be a little bit busy. I'm hoping that most everybody will be finished by tomorrow night and won't be doing this at the last second. I think I mentioned it already, but we had a very unpleasant scenario 2 years ago when a lot of people waited till the Thursday night before, and my GTRA was up till midnight answering questions. I would like to avoid that. I think everybody in this room would like to avoid that too. So be proactive on this. I'm happy to answer questions in my office. Should be in my office most of the day tomorrow if you need to come by and ask questions about some things. But hopefully everybody's making some pretty good progress on this and has made steps towards this. Well, one other question that did come up is it okay if you make these numbers to the nearest 1,000 or the nearest million? And that is absolutely fine. Okay, that's for presentation purposes. You do not need to leave this as the Morningstar interpretation sets it. If you want to basically divide everything by $1 million and then have and then just say all amounts in millions, that's acceptable as well to keep it simple. What is it that I always say that Einstein says? Everything should be made as simple as possible, if not simpler. And that's my goal here. All right, with that, we are moving on to chapter 13. Chapter 13 will be our last control table, which is kind of nice, but we have some unique considerations here. I've not figured out exactly how to present this material because I do like chapter 12 and 13 working next to each other, but chapter 13 is substantially more involved than chapter 12. And so It's really odd because I feel really awkward on chapter 12. It's lecturing like 30 minutes, and then chapter 13 lecturing like 45-50 minutes, even though it seems like they should have similar amounts of content. But there's a lot that goes into inventory management as far as the audit perspective goes. If you work in auditing, and some of you who, even those who will not work in auditing, you may encounter inventory. Inventory is kind of a big issue in most organizations, particularly those that are inventory based organizations. The counts that go into it are very involved, and they have to be very specific as far as their approach. We're going to talk a little bit about how an inventory count works a little bit later. We've already alluded to this a little bit. We had some assignments on it back in chapter 5 when we talked about sheet to floor and floor to sheet testing. Some of those things are going to be reiterated, but we're going to go into a little bit more depth in this chapter about what all those things represent. So the very first thing we need to talk about with respect to inventory is why is it a separate process? And the answer is it's not really, but we kind of treat it as a separate process because it's the overlap of two process areas. Now, if you remember this from AIS, we talked about this very specifically. We talked about the conversion process in AIS. In AIS, we said inventory is basically when you generate purchase raw materials and generate that into a finished good. Now, not all the organizations we're going to be dealing with will be manufacturing organizations, but most organizations do have some inventory footprint. If it's a true service organization, you won't have that. Like I do think for some of you doing your Excel assignments, you do have financial institutions, which means that you probably won't have any inventory concerns. But for the rest of you are going to have some insight as to what inventory means. And it's usually a substantial account for many organizations. So if we consider the context of processes that we've already discussed, purchasing and revenue, purchasing companies purchase inventory, whether raw materials for inventory or raw materials for inventory production. So for retail organization like Walmart, they're going to purchase large quantities of inventory, then they're going to break that down into much more manageable amounts to sell. Now, Walmart doesn't really do anything different than we do as customers, but because they purchase such large quantities, they're able to do that at a much lower price. We probably could get away with the same deal too if we were willing to buy, 5,000 pounds of bananas at a time or something along those lines. I've often thought about that. It would be great if I could just buy like 50 cheeseburgers in bulk and just go with that. But unfortunately, even with my fascination and my ardor for cheeseburgers, I think I would be hard pressed to consume that within a reasonable period of time. So retail purchasing is pretty much just based on quantity, whereas manufacturing is going to be based on purchasing items for conversion. So the example that I always use is turning a piece of wood into a chair or a table. That's kind of how we think about that. So yeah, that's the purchasing aspect. And then of course, the natural offset to that is going to be the sale of inventory. Companies will sell inventory to generate sales revenue. That's been the blueprint for most of the organizations we've talked about. And even though many organizations are becoming more service oriented, I still think inventory has its place in business, and it's still going to be a very important account that we have to deal with. So let's go ahead and start talking about the things that we need to note. Now, the good news is we don't really have to do a deep dive into the different process areas of inventory because we've already learned about that from other courses. It's been a big focus of your financial accounting courses. And for the most part, it's all kind of conglomerated together. We could, if we wanted to, we could break down the processes of each of the steps whether go into inventory manufacturing, inventory retailing. But at this point, my assumption is most everybody is familiar with that. So instead, we're going to move straight on to the documents that are associated with inventory. Now, a lot of these are going to be unique to manufacturing environments. So if you are working for a company that actually has inventory manufacturing, you would see these. We're talking about a retail inventory company. Many of these reports are not going to be as relevant. So production schedule, receiving report, materials requisition, inventory master file, production information, acclimation and variance, inventory status, and shipping order. For a retail company, we probably only would have receiving reports and inventory status and maybe even shipping orders. But again, these are things that are familiar. You will notice this is not a comprehensive list. And a part of that is because we're trying to isolate things that are unique to the inventory management process. If you say, well, where are the purchase orders, Dr. Barnes? Where's the shipping reports? And the answer is, well, those are already in other process areas. The purchase orders are going to be in the purchasing process. The shipping reports will be in the revenue process. These are things that we're already familiar with. So we're not going to try to focus on the overlap as much as we're going to focus on the areas that are unique to this process. All right. So when we think about this, we do need to keep the revenue and purchasing processes in mind, but we also need to know there are separate issues that are unique to this particular to human or to the inventory management. All right, with that, this is going to be a little bit less than effective because we're going to be talking about functional areas of the inventory process. Some of this is going to be hard to define. Some of this is going to be relatively easy to define, but let's go ahead and go through this. So what do we mean when we talk about inventory? We talk about inventory management. This is basically where we identify that there's a need for inventory, and there's either going to be an authorization of purchases or an authorization of production, whatever the need may be. In some situations, it may be both. If we're talking about we need more inventory and there's not an existence of raw materials, then there would have to be purchases for production. But whatever it may be, we're just trying to actually acquire new inventory for whatever the purpose may be. Now, the next few are going to be unique to a manufacturing environment, but we do need to delineate them from the retail environment. So we have raw materials, manufacturing, and finished goods, which we know that those are all representative of different phases of inventory. What is the term for it back that you learned in 221 and probably held on to cost accounting when goods is in the process of being manufactured? What do you call that?
Work in process.
Yeah, work in process. Yeah, work in process. So that's all that represents there. Now, it's important to note, if we're talking about a retail environment, those first two categories do not exist. All the goods that we purchase are going to be finished goods because we're just going to just basically unpackage them and sell them as they are as they are set up. So think about it. Easy example. This is where my mind always go to when I think of Walmart when they purchase like an electronic system like a Nintendo Switch. Okay, they don't manufacture their own Nintendo Switches, or they don't receive raw materials. They buy those straight from Nintendo, and usually the margins on those are really, really small. So it's important to note that they're trying to take advantage of being able to sell those direct to the customer, which is probably why it's better just to buy online for those things anyway. That's not relevant to this lecture or even to this course at all. It's just something that it's not manual observation here. All right. Then we have the cost accounting. Again, cost accounting is going to be very heavily predicated on the idea that we're going to be in a manufacturing environment. So we want to maintain production and purchase data. It is possible to maintain cost accounting information for service environments as well as retail environments, but it's generally going to be less challenging. So we're going to kind of focus on the manufacturing aspect of that, since everybody's already familiar with that. And then finally, we've got our accounting, our general ledger three-way match. Our documentation is important to note that we have a lot of different areas that we can actually match documentation here across the production phase. Production authorization, the production item or the production items or production process, as well as the actually accounting for the information later on. So different documentation can actually be matched to verify the validity of the production. Interesting footnote here. Book notes that segregation of duties is particularly important for inventory. What do you all think? Do you think that that's an accurate statement? Do you think segregation of duties is particularly important for inventory? Yes, no, maybe, haven't thought about it, don't want to think about it. So let's think about an example here, okay? Let's think about the necessity. So in a traditional environment, we would want to have separation of custody of assets, authorization of transactions, and recording of transactions, okay? Now, a lot of the grocery stores here in Kirksville, and these are true for grocery stores worldwide, have actually implemented self-checkout. Has anybody had to experience that? Yeah, I think most everybody's had to experience that now. How do we feel about self-checkout, by the way? Everybody likes self-checkout, and it's like, if you're only buying one thing, it's great, okay? It's just kind of like get in and out and get it done. But the problem with self-checkout is that it's become so ever-present that it's basically all that's there. I go shopping on Saturday nights because I'm that boring. Okay. And so I usually do my shopping and I get my shopping cart full, and usually like late on Saturday night, like 9 o'clock, before when Hy-Vee no longer has somebody at their check stand. So I have to do all my self-checking out. I'm just kind of like, this sucks. I want somebody to do this for me. But particularly speaking, we can say that self-checkout's good under certain circumstances. All right. And the logic behind this is pretty sound. You know, these stores have basically said it's cheaper for us to do self-checkout and have somebody else to do that than hire somebody to verify that. But from a segregation of duties perspective, is there a problem here? All right. Is there a problem? So you're the customer, you've got the goods in your cart, so you've got the custody of the inventory. Now, normally speaking, the recording step is going to be done by the system itself because you scan the goods in and it records the purchase. So that's separated out. But what is the whole purpose of having somebody to do the checking out for you? It's to authorize the sale of that inventory, authorize those transactions. That's why we have somebody at the cash register. If there's not somebody who's checking the goods out for you, who's responsible for the authorization of the transaction? You are, okay? You are. You now have custody and authorization functions in your hand. Now, can anybody speculate on ways that that might go wrong? Okay, that might go wrong. Now, I know everybody in this room is perfectly ethical. And the answer is no, Dr. Barnes, that would never be a problem in my situation because I'm going to pay for everything that I put in my cart. Okay. Now, let's just speculate. I want you all to hypothesize, okay? Or just pretend. We're going to be doing a little imagination. Imagine that you're not a perfectly ethical individual, okay? And that you recognize that Dr. Barnes has talked about this custody authorization dilemma, and that it's possible that you could actually put something in your cart and then fail to scan it. You could fail to authorize that transaction, and by that way, that means that you also don't have to pay for that particular good, all right? So can we see why the separation of lack of segregation of duties is problematic? Because it might lead to theft, or as the stores call it, they call it shrinkage of inventory. Okay, it's an intentional theft, and it's basically because of the lack of segregation of duties. So this should be a dilemma that's not particularly difficult to figure out based on what we know from kind of the environment that we're operating in nowadays. Is that if you remove segregation of duties, you increase the propensity for theft. And by the way, the theft has gone way up for retail establishments. Probably not so high up that it's basically said we're still going to pay more people, but there are actually some stores that are actually operating in other countries that said we're going back to the old ways. The theft has just gotten too ridiculous. Okay, so all it requires is that you just abandon all of your ethical principles. So I'm not encouraging you to do that. I'm just saying that that's all that you have to do. You have to abandon all ethics, and then you can get a good deal on groceries, I guess. I don't know. There was a we had a speaker in advanced AIS last semester who was he was an executive at Schnucks, and he said that there's a lot more controls over this than we realize. So I'm simplifying the process. I guess the good idea is just don't steal. Okay, even if you have the compatible or incompatible duties of custody and authorization, there may be redundant controls in that area that you need to be aware of. All right, so. I don't want it coming back like a few weeks from now, like somebody's in jail and says, Dr. Barnes told me I should do it. I was like, that's not what I'm saying. I'm being snarky. I'm being snarky when I'm saying that you can abandon your ethics and get free stuff. Okay. That is me being facetious. Do not take my advice. I'm not seeing my reaction. I'm really worried that somebody heard part of what I said and not seeing the disclaimer of saying don't steal. Okay. Yeah. Okay. It's gonna be my catchphrase. Don't steal. Don't steal. All right. That's the goal. Even if you can, don't do it. All right, inherent risk assessment. What should the auditor consider as part of inherent risk assessment for the inventory process? Well, obviously, industry conditions, because we've talked about that in the other process areas. The threat of competition and new entrants, that's obviously going to be a big issue, and it's going to remain an issue in any process area we deal with. What about changes in technology, obsolescence? Is that going to be a big risk for inventory? It really depends. If we're talking about something like cheeseburgers or bananas, probably not. There's probably not going to be a newer, nicer cheeseburger that's going to take over the competition. Maybe, but possibility. But what about actual technology? Okay. Has anybody seen this thing right here? This is my favorite device of all time, and it no longer exists in any reasonable capacity. You know, it was great because, you know, I have big thumbs and I'm clumsy. And so like I could actually tell when I was pressing the buttons. Now I type in on my iPhone and I'm trying to type in and something that I said, and then all of a sudden I noticed that there's no spaces in anything I had because my thumb actually hits letters instead of spaces. And so it's a big agglomeration of words. I miss my BlackBerry, but BlackBerry definitely is not longer. It was suffered because of the change in technology, the obsolescence. It's an obsolete device, and certainly that's something we have to be concerned about. What about fraud risks? So, quick question: do you think fraud can occur with inventory? The answer is probably yes, considering we were just talking about stealing inventory. Okay, the thieving of inventory, the stealing of inventory, misappropriation of assets. But we've talked about other types of fraud. We talked about fraudulent financial reporting. Can organizations misrepresent inventory to their own gain? So what happens if you overstate ending inventory? What happens if you're the CEO of an organization or COO of the organization, CFO, there we go. We'll say CFO. And you say, I'm going to increase ending inventory for this period by $1 million. All right. What is that going to be the eventual effect on the financial statements? So you increase ending inventory, which decreases what? Cost of goods sold? Calculation of cost of goods sold, if you do that, okay. If you decrease cost of goods sold, what happens to income? Cost of goods sold goes down, income goes up, and therefore your financial statements look better. In fact, that is a massive, massive fraud that has occurred across many organizations. There's the restatement of ending inventory to overinflate ending inventory. To say ending inventory is much higher than it is. That's something that fraud schemes, everybody thinks they're brilliant when I do it. It's something that occurs frequently. This is an area that's rife for fraud, and it's very, very difficult to validate, simply because inventory counts can be very, very extensive and difficult. Also, this is not it's technically an area of fraud, but it's an area that we talked about, related parties buying and selling. Is it possible that an organization or entities within an organization could get preferable treatment to related parties? They could buy from a related party at a much higher price than they would from other parties, or they could sell at a lower price. That's a possibility as well. So we do need to be very cautious about that. Suffice to say, the fraud risk for inventory, the inherent risks of inventory are massive. There are a lot of inherent risks in this area. One of those goes to the nature of inventory. What do we talk about? We talk about fraud. We talk about the nature of fraud being is that if it's a liquid asset, it's very susceptible to fraud. How liquid is inventory, is most inventory? Can you actually go out and resell inventory in the open market? Like if you go into Walmart and note that the custody authorization function is missing, so you just go ahead and steal a few devices from electronics and then take your card outside. Can you resell those on Amazon or eBay or someplace like that? Yeah. Okay. So the liquidity of inventory creates a lot of risks associated with it. All right. We're going to continue on with our reliance strategy for our control risk assessment. Now, I know that you all are really excited and really ready for the substantive strategy. And next week when we do it, I expect a big, loud, rousing round of cheers when we finally get to substantive strategy. We're not there yet. It's pretty obvious why, okay? Because we're talking about inventory purchasing and selling transactions. And the simple truth is there's too many of them for us to substantiate individually. So because of the volume of transactions, we do want to rely on the entity's internal controls, okay? So we're not quite there till we can get to a substantive strategy. We do want to make sure we have a reliance on internal controls. If we're using a reliance strategy, that means we have to test internal controls and we have to validate the control risk. Okay, so as I said before, we got one more table, one last table. So how many does that make? That makes 6. 2 for revenue, 2 for purchasing, 1 for payroll, 1 for inventory. Those are the 6 tables you should focus on. By the way, everybody keeps wondering, what are these 6 tables about? There will be a problem on the exam, okay? And it will basically ask you, what is the, it'll give you a risk that I've identified. It will ask you, what is the assertion related to the risk? And you'll have to identify an appropriate control for that particular risk. That's been consistent for all the exams. What I usually do is I will roll a dice. Okay, I'll roll a 3-sided die, not a little one, real one. I don't think there's actually such a thing as a 3-sided die, but I will roll a die, a virtual die, and I will pick 1 through 3, and I'll randomly select either revenue, purchasing, or inventory and human resources. And the questions will come from one of those areas. And if you're curious what that looks like, it's actually on the practice exam. Yes.
You say the tables 2 from revenue.
So there's 2 from revenue, 2 from purchasing, and 1 each from human resources and inventory. Now the 2 from revenue, 1 deals with revenue transactions, 1 deals with cash receipts transactions, and the 2 from purchasing, 1 deals specifically with purchasing transactions, the other 1 deals with cash disbursement. But all 6 of them are really important tables. Plus, I will ask multiple choice questions about those tables as well. So it's really important to make sure that you focus on those tables. But we've seen examples of these tables already. Let's go ahead and take a look at our last example for this particular concept. Assertion is going to be completeness, all right? Completeness of inventory, which we know is going to be a real concern because an organization may receive inventory and then fail to record it in their system. So they've got it sitting out on the floor, but they don't know that it actually is in the system. They don't know that it's out there, okay? So inventory is received but not recorded. How do we actually prevent that from happening if we're an organization, all right? Well, this is something we talked about actually in my AIS class today. We were doing the receiving process in NetSuite. Does everybody remember that? Remember all good old NetSuite saying, okay, I remember the receiving process. And Dr. Barnes talked about something called a 3-way match. 3-way match. That's where we look at previous documentation and actually make sure it's consistent. So we can match the receiving reports to the vendor invoices and the purchases journal. Now, in the situation I was talking to my students about, it was a retroactive 3-way match. We were looking at the purchase and sales orders, but we're testing completeness here. What do we want to make sure is happening with completeness? We want to make sure if something exists, okay, it gets recorded. So something that actually took place is in the system. So our 3-way match is going to be proactive. It's going to say, let's take the receiving report and let's see that this matches the subsequent items that should have been recorded, the vendor invoice, and then the vouchers that went into the system. All right, the purchase journal. Okay. So that's how an organization would actually identify a control activity in this area. We as auditors, on the other hand, we want to test this. So what's an appropriate test here? Well, what do we usually call it when we're testing, what is the directional test for completeness? I'll give you a hint, it's either vouching or tracing. Tracing, okay? So what if I trace a sample of vouchers to the purchase journal? So remember, the vouchers are those packages of everything that's in the purchases, and I want to make sure that the information that was in there is actually in the system. So I start with the source documents and I move to the system. Is that tracing? Yeah, so going source to record, okay? So that's the tracing test of it. So the question is, do all these support the completeness assertion? Hopefully, the answer is yes. All right. Now, with respect to moving on, this is our control risk assessment. Remember, once we're done with control risks, we consider the possibility of what it is that we need to do with substantive testing. We have substantive analytical procedures and substantive test of detail. Now, there are some possibilities for analytical procedures in this area. One of these is going to be looking at trends and ratios over time, as we've talked about before. But there are some areas of specific interest we want to make sure we're familiar with. So we want to actually see trends for raw materials, finished goods, and total inventory turnover. Days outstanding inventory turnover, or days outstanding inventory, which is just a function of inventory turnover. We can actually look at gross profit and compare that by a trend analysis. This is one that's extremely important, by the way, for many organizations, and one that's done very, very thoroughly. And the reason why is pretty straightforward. What is gross profit? What is the how do we calculate gross profit in income statement? Does anybody know? Hopefully everybody knows, but sales minus cost of goods sold or cost of sales, okay? So if you see a misrepresentation in gross profit, let's say that gross profit is 20% consistently for a 5-year period and then it jumps to 30%, that identifies two possible areas of interest. Either sales are overinflated or cost of goods sold are underrepresented. So looking at gross profit can actually look at two possible areas of interest for us as auditors. So this is why this is such a powerful analytic procedure. We can also compare to budget, okay? And we're going to talk a little bit about comparing standard costs. We're going to talk about how we audit standard costs in just a little bit. And then we can also to look at standard the overhead cost as well as how they represent there. Now, does everybody remember good old overhead from the cost accounting classes? Feel pretty comfortable with that? Okay. For those of you going to the graduate program, get ready for management seminar. Okay. Yeah. So you got to revisit overhead again. Yeah. Overhead was one of those things back in 221. This is why I'm so glad to be done with that. And then you took 367 and said, oh no. Yeah. But yeah, overhead. Does anybody still have to take 367? I'm just curious. It's just, yeah. Okay. Hopefully I'm not spoiling anything. Hopefully everybody is in this class. It's like, yeah, I've had that experience. Okay. But we'll talk about a little bit of representation. We're not going to go into nearly as much depth as Dr. Otero does because I'm an auditor, not a cost accountant. All right. So we talked about our substantive testing. We're wrapping up with our test of details. So all of these are examples of test of details we're going to perform. Let's talk about what the assertions they represent. So tracing a sample of receiving reports to the inventory record. So I'm going to look and see what was received, and then I'm going to check and make sure that that's what's in the system. All right. Tracing is again a test of which assertion? Completeness. Yes, this is our completeness test. Recompute the mathematical accuracy of a sample of inventory transactions, audit standard cost or other methods used to price inventory. Again, we're going to talk a little bit about auditing a standard cost. It's not particularly difficult, but there are some concerns in this area. But if you see recompute, what does recomputation always test? VAA, yes, VAA. Example of sample of inventory checks for proper classification and expense accounts. You know, I really should update these and just like at least try to change the word classification to like categorization. You know, you think I'd be a little bit less lazy. This is just kind of copied and paste from the book though. So what do we got here? Classification. Yeah. Someday I'm going to fool somebody with that. I'm going to use classification, but it's going to not be used classification in the context of classification. And everybody's going to be so surprised. Review a sample of time cards before and after period into the appropriate weekly inventory report. What kind of test is this that we're talking about in this one here? It's a cutoff test, and cutoff tests always test cutoff, okay? Voucher sample of inventory additions to receiving reports and purchase requisitions. So we're talking about information that goes into the system. We want to actually validate that it was the source documents that represent that. So we're moving from top to bottom. That sounds like a vouching test, which vouching tests systems occurrence. And by the way, when I talk about directional tests, you should be intuitively understanding what I'm talking about by now. If you're still struggling with the idea of why does vouching test exist as occurrence or tracing test completeness, get on that right now, because my assumption is that you know this well. If I say that, well, what's my recording assertion? You should be automatically saying completeness, okay? If I say, why is this a cutoff test? And you said, because we're looking at before and after period end. This should be intuitive by now. If you're still struggling with the assertions, you need to be on top of that, okay? Because the assertions are going to be very important for the upcoming exam. All right. Well, We got one more. Let's go ahead and do one more slide here. All right. So this is going to be the testing of account balances. So we want to verify inventories of consignment for others held on bills and hold goods are not included in inventory. So we've actually taken goods onto consignment by our organization. They're not owned by us. They're owned by somebody else, but we're trying to sell them for them. Okay. So we're the consignee in this situation. If we're talking about items that we're trying to determine ownership, what does that sound like to you all? What assertion? Rights and obligations. Very good. Okay. This next one is kind of stupid. It's actually I should be having a longer description in here, but it's observe the physical count of inventory. The answer to this one is technically there's two primary assertions we're concerned about. We're concerned about both existence, occurrence, and completeness, but I only listed existence occurrence because I've got completeness a little bit later on. Obtain a copy of the inventory compilation and agree totals to the general ledger. When you see the word agree, what are we generally talking about when we talk about agreement and auditing? 9 times out of 10, it's usually referring to which assertion? VAA. Yeah, VAA. And then finally, tracing test counts and tag control information of the inventory compilation. So basically, whatever our sheets say, we want to make sure that the information at the bottom actually ties up to the information at the top. So we look at the source, the stuff on the floor, and we go up to the sheet. Okay. So we're moving bottom to top, which if we're moving bottom to top, what is that a test of? This should be a give me on this one because I actually told you it was going to be coming up later. So completeness, yes, yeah, completeness, which is why I didn't list completeness up here. Okay, completeness up here. Don't worry, we're going to talk a little bit more about inventory counts here in just a second. But let's go ahead and let's talk about standard cost. Everybody remember standard costs or managerial cost accounting? So the idea behind this is if you're in a manufacturing environment, that you have certain costs that you expect for every unit of production. Because if you're making a cheeseburger, you expect I'm going to use a 1/4 pound of meat because obviously, why wouldn't you? 1/4 pounders are delicious. Okay. You use 1 slice of cheese. You're going to use 3 pickles. You're going to use mustard. Whatever the ingredients are, you've got standard items of those. They're a certain price and they're a certain quantity. All right. And then from that, you can judge your standard cost. All right. So that's how we actually establish standard cost. More technical definition is actually the standard is a price or cost or quantity that's expected under normal conditions. The standard cost system is the accounting system uses standards for product cost. And that's actually a quote from my 221 class, which sadly is now deceased. Okay. But maybe coming back here in the know of the year. Who knows? Okay. I may teach 221 again. Did anybody in here take 221 with me? So there was a big gap. Like when I took over AIS, it was like multiple years. And then I actually have a student that took 2 students in my AIS class that took 221 with me last summer. So, all right, my mind is wandering. I'm going to stop. I'm going to try to focus, guys. I'm going to try to focus. Yeah, it was very, very weird. It's very weird not teaching 221 anymore. So how do we audit standard cost? That's the interesting question. All right. The answer is what is cost accounting all about? What are the 3 words in cost accounting or managerial accounting? Those 3 magic words: materials, labor, overhead. We're going to focus on those. All right. I don't care what Dr. Sotero says. That's all cost accounting is: materials, labor, overhead. She's going to come in. She's going to smack me, but I'm going to continue on with that. So let's focus on materials. We want to test the quantity and type of materials included in the product and price of the materials. So we want to make sure that if we're using that amount of meat, that amount of pickles, the amount of mustard, whatever it is that goes in that cheeseburger, that's consistently used and the price that's recorded is consistently the same amount as what our expectation is. That same line occurs along with labor. Okay. Want to gather evidence about the type and amount of labor needed for production and labor rate. So if it takes me 3 minutes to make a cheeseburger, it's got to be consistent 3 minutes and noting what my rate of pay is. Okay. I probably would not make a great cheeseburger cook because I'm going to demand a lot more than that $3.35 per hour that I was earning at McDonald's back in the day. All right. And then overhead. We want to make sure we review the entity's method of overhead allocation for reasonableness, compliance with GAAP, and consistency. Now, I know that everybody saw compliance with GAAP and alarm bells immediately went off in your head, and you're just like saying, Dr. Barnes, you're a dirty liar, okay? Because overhead does not comply with GAAP. Managerial accounting does not have a set of standards associated with it. Why are you talking about compliance with GAAP? And I say, hold your horses, okay? Very good insight for those of you who identified that overhead calculations do not comply with GAAP. But we do need to understand that the information from the overhead calculation flows into the product costing calculation, and that inventory calculations do have to comply with GAAP. So the inventory methodology that we use for calculating inventory costs, those do need to be compliant with GAAP. So even though managerial accounting, cost accounting, they do not have to be GAAP compliant, the eventual financial transparency that's associated with that does need to be GAAP compliant, which is all that I'm referring to here. All right. So I know that this is the moment that we've been waiting for, okay? Because many of you are saying, I'm going to be doing auditing in the very near future, Dr. Barnes. And what I'm really looking forward to is doing an inventory count. I can't wait to celebrate New Year at a client site, okay? Drink a little bit of champagne, have that whistle, wear a hat, and then all of a sudden start doing an inventory count. Well, I'm here to tell you exactly what we're going to be concerned about with an inventory count, okay? So they're a regular important part of audit testing. Before beginning inventory account, an auditor should do what? Okay. So ensure that no inventory production or movement will occur during the count. Verify the count documentation is properly assigned. And most importantly, ensure that instructions for the count are clearly understood by the count teams. That sounds like such a simple and minor issue. And yet I had experiences with this where it was so problem. This is why on the slides, if you're looking at the PowerPoint slides, there's another image on here. It pops up when I click. It's like me with an angry dog. That's me right down there, okay? It's because I did inventory counts where the instructions were not clearly understood. And when I tried to reach out to the senior associate, they're like, I'm on vacation, okay? There's actually a much longer story to that. It's a very interesting and fascinating story, but it had to do with the fact that I was doing an inventory count and my senior associates were basically blank and absent. And I was like, I've got a problem here. How do I answer this? I'm on vacation. That was my response, okay? So let's go ahead and clarify what we mean by an inventory account, okay? So is the auditor doing the entire count themselves? The answer is in most situations, no. I'm not going to say it's entirely exclusive. I did the entire inventory count myself when I did my inventory counts for the chemical testing company that I was working for, mostly because what we were counting was big gallons of liquid, okay? And so we would actually climb to the top of a big drum. Has anybody ever seen those chemical storage drums, okay? They're like 100 feet high with like narrow railing around the side. And this is the month of January in Oklahoma where the winds were blowing, okay? So climbing up to the top around those, and then you have to drop a dipstick, a very large dipstick. It's actually a chain with a dip on it. You have to actually see what the calculation is. So yeah, that's how do you do an inventory count for that type of thing? And I did the count for all the drums that were on the premises, which was basically like 15 drums. So you can do an entire inventory count. But for the most part, for a traditional retail or manufacturing establishment, you're only observing the inventory account. This is an important step, by the way. I know my storytelling got in the way, but let me go ahead and back up. For the most part, the auditor is just observing the inventory account. Okay, so it's an observation process. That being said, it is possible for the auditor to conduct certain counts on their own. So if we say the client is conducting the account and we're observing the process, that's very low reliability. But let's say I conduct my own test count. I say, I want to verify the count of that particular inventory item over there. So I do the count on my own to verify that my count matches what the client has. Okay. That is a high test. That's a reperformance test. Okay. And both of those are viable in an inventory count. So for the most part, the auditor will not perform the tests themselves, but they can actually exclusively test certain items. There's a little bit of a distinction there. For the most part, it's an observation, but the individual test counts can be a reperformance test. And what do we know? What do we say about reliability of observation? It's high, medium, or low. Observation is low, reperformance is high. That's how we actually get validity in that area. All right, so let's review some of the things that we should already know about. But how are assertions tested in inventory count? So existence occurrence. This is one of our primary assertions because we're talking about assets and we want to make sure they're not over-reporting their assets. So we want to compare inventory quantities on record to the observed inventory quantities. This should sound really familiar, by the way, because this is exactly what we did back in chapter 5. Remember I said, let's start with what is on the sheet, and let's take that sheet and walk down to the floor and see if the numbers on the sheet match what's on the floor. Was it important that we started with the sheet? Yes, because we're starting with what's recorded, and they're going to actually match to see what actually exists. So that's why existence occurrence is tested here. Sheet to floor is a directional test. We're starting from the top and moving to the bottom. All right. To that end, completeness is also a very important assertion because we want to make sure that if something has been something actually exists, it's on the floor, that it's in the system. We don't want the inventory coming into the facility that doesn't get recorded, which sounds like a lesser concern. But if you get a company that's not got a good business model, they can start receiving inventory and fail to record it. So what do we do then? Well, if existence occurrence was sheet to floor, what is completeness? Floor to sheet, okay? We start with the quantities that are observed, the stuff that's on the floor, okay? Stuff that's in the warehouse. We say, this is what I counted. Now let me go compare that to what's in the system. Let me compare that to what's recorded on this sheet of paper, okay? That's what Florida sheet means. Again, these should be very familiar. You had an example of this, or example of this from chapter 5. You also had an exam question on this particular concept, so it should be just reinforcing that. Let's talk about the other assertions, okay? So valuation allocation accuracy. We know that transposition errors can affect valuation allocation accuracy. That was one of our examples, but there's a lot of different other areas that we could be concerned about. We do also want to make sure that you observe the condition for inventory for items that may be obsolete, slow moving, or carried in excess quantities, okay? So you're in your inventory count and you notice over in a big stack over in the corner that they appear to have big boxes that have not been touched in decades. And you open the boxes and you find, lo and behold, it's full of blackberries. Not the fruit, the actual the item blackberries themselves. They're saying, okay, that's in your inventory. How much you holding that? It says, well, we expect to sell those for $1,000 a piece. And I said, yeah, that's not going to happen. All right. You're going to have to write this down because those are basically worthless right now. So that's an example of inventory obsolescence that we need to be aware of. Okay. Also, rights and obligations, inquiring about goods held in consignment for others held on a bill and hold basis. So this can actually move in both directions. If we're the consignee, if we're actually selling goods for another organization, we cannot represent ownership of those goods. All right. On the other hand, if we're a consignor, we actually have somebody doing goods selling for us. Even if we don't have physical possession of the goods, they are still considered to be our responsibility, our ownership. So consignment is a really tricky one. We want to make sure that if we can understand consignment, that we know what the terms of the consignment are. And if somebody's selling goods for us, that we still maintain possession of the goods on the balance sheet. Or if we're selling goods on some behalf of somebody else, that we don't put those on the balance sheet. Finally, we've got cutoff, okay, which is a transactions event assertion. That being said, it's still relevant to our account, okay? We want to make sure we obtain cutoff information, including the number of last shipping and receiving documents issued. One of the biggest ways to misrepresent inventory is to actually misrepresent when it was shipped or when it's received. This happens a lot in sales and purchasing schemes. So cutoff testing of inventory can be very, very important. That was one of the things that we talked about back in chapters 10 and 11, and it still remains prominent today to make sure that we do proper cutoff tests in this area. All right. So that pretty much talks about all the things that we need to know with respect to observation inventory. The problem being is that there's a whole long list of other things we're going to talk about. Now, I've only got 7 minutes, so I'm not going to take 7 minutes. I'm going to try 7 minutes or less to talk about this. But some additional considerations we need to know when we talk about inventory observations and inventory counts. First off are going to be the possible causes of book to physical differences. All right. So basically, whatever's recorded on the client's system, if we compare that to the physical count and we notice that there's differences here, we need to reconcile those differences. So the client says that they've got 100 of a particular item. We'll say 100 cheeseburgers. I realize that most people don't store cheeseburgers in the completed state, but that's the best I got for you. Okay. So they got 100 cheeseburgers, but you only counted 50. And you say, why is the count different here? There's a couple of reasons for that, a few reasons of possibility. So first of all, it could be inventory cutoff errors. Okay. One cutoff error could actually be a recognition of when something should have been shipped and when it's not shipped. Okay. So the timing actually could be very, very relevant. We could have unreported scrap or spoilage. All right. Something that said, all right, we forgot to write off 50 of these cheeseburgers were no longer fit for consumption. So we actually threw them away, which is a travesty, by the way, that should never happen, but it happened. Okay. So we didn't report that, but it actually happened that we actually threw those cheeseburgers away. And then our big enemy that we're talking about, pilferage or theft, which I don't know why they included, why it's included pilferage. It actually doesn't mean anything other than theft. So it's theft or theft is basically what that statement is. All right. But something got stolen and didn't get recorded. That's a really big cause for concern, especially in unsecured areas that don't have strong internal controls. Not going to mention any names, but maybe our grocery stores here in Kirksville. Who knows? Okay. Also, we need to know the inventory cost method. We do need to understand what's going on with the inventory cost method and make sure that's consistent with the things that are being represented. And we can't properly value inventory unless we know what the inventory cost method is. Also, as auditors, we have a responsibility to make sure that the client is using a proper inventory cost method technique. Do y'all remember that back from your financial accounting classes? You learned about good old FIFO and learned about LIFO and retail and things along those lines. As long as it's a GAAP approved method, then generally speaking, it's okay. If it's a non-GAAP approved method, we as auditors have a responsibility to say, you can't use that method. You need to change to a method that is approved under generally accepted accounting principles. Okay, recognition. It's important to note that under generally accepted accounting principles, you can't mark to market inventory, even though that seems like a logical thing that you'd want to do. So market valuation of inventory is not allowed. Next, we have purchase contracts, consignments, pledged and assigned inventory. We talked about consignments. Pledge and assigned inventory is very similar to that concept. Purchase contracts. If we find that certain inventory is going to be required for future purchases that may be set aside and actually removed from the inventory count. It depends on what ownership conditions exist. If the client has already paid for it, then we can actually say the client may have ownership of inventory even if they don't have physical possession of it. We would want to actually review the terms of the contracts and the pledge to assigned inventory. And like I said, we've already talked about the nature of consignments. LIFO liquidations. So we know what LIFO is. Has everybody heard of liquidation, LIFO liquidation before? How many people have heard that term before? Nobody. Well, we're going to learn something today, okay? So what happens in normal times? Does the cost of inventory over time generally go up or down? Generally, over time, the cost of inventory goes up. Okay, so if you bought a cheeseburger for $5 today, in 10 years from now, it might be like $7 or $8. That's a thing called inflation that we've dealt with for a period of time. Cost of items tend to go up over time. Okay, so if we're on a last in, first out basis, what does that mean? It means that the stuff that we're selling is the stuff that's the most recent purchase, not physically speaking, but from a bookkeeping perspective, it is. What does that mean about the stuff that's on hand on inventory? It is very low cost, okay? So imagine that your client has a really great year. They sell far more than they produce, and they have to dip into their existing inventory. What is that going to do to their cost of sales relative to total sales? Is cost of goods sold percentage going to go up or down? It's going to go way down because we're selling old inventory that's very low cost, okay? So that's going to mean that the company is uber profitable in a given year. Does that sound reasonable? Is everybody following my logic here? Okay. Cost of goods sold goes way down, profitability goes up. Is that sustainable over a period of time? No, because if you sell off all your old inventory, the stuff that was held on the books at a low cost, then you no longer have that inventory. And so that's what we call a LIFO liquidation. Usually that requires a disclosure in the financial statements to say we were selling old inventory held at LIFO. It made sure that we had record profits for this year, but these profits will not exist in coming periods because we no longer have that inventory on hand. That's an example of a LIFO liquidation. Then we have purchases or sales to related parties. What is our requirement for related parties? So under GAAP, remember, our clients are required to disclose any related party transactions that exist, okay? So that is our primary responsibility as auditors, is to make sure our clients are reporting all related party transactions. Is there anything else that we might want to assess as auditors with respect to related party? When we talked about related party, we talked about something called at arm's length. Does everybody remember that? Okay, picture of shaky hands. Okay, we want to assess whether these transactions are occurring at what is perceived at arm's length. For the most part, related party transactions are not considered to be at arm's length simply because they are related parties. We as auditors are going to make a separate assessment of that. And if it's a related party, we could say this transaction is based on terms that are not reasonable for other parties in this area, or they are reasonable, but we want to try to make an assessment of that. And then finally, warranty obligations. Those are just as they sound. Keep in mind that if we have inventory that has warranty obligations associated with those have to be booked in advance and estimated as part of cost of the inventory. So that's something that we have to make sure the transactions take place associated with that. Whew, it's an exhaustive list. Everybody remember this? I'm testing this entire slide on the exam. All right, I'm just joking, okay? I do like the concept of LIFO liquidations, though. All right, we're done with inventory. See you all on Friday for homework.